To properly analyze a stock, investors will calculate certain ratios to help them compare one company to another, say Apple to Microsoft. Or they will calculate a ratio to compare a company today to itself a year ago. By doing so, you can see how the company has changed over time. Ratios help us compare one thing to another thing. You might want to see who has the cheapest fuel, so you will take the cost of fuel and divide it by the quantity of fuel. That's why you often see fuel prices in cents per litre or cents per gallon. Or you might want to compare the cost of potatoes. You'll take the cost in dollars and divide it by the weight in kilos or pounds. By doing so, you can determine which potatoes are the cheapest. Financial ratios are the same. High debt can potentially lead to financial troubles. You might want to compare how much debt one company has to another. You find that Company A has 10 million in debt and Company B has 50 million in debt. What does that actually tell you? Not a lot. We know Company B has more debt, but what if the companies are different sizes? What if Company B earns more profit? We need something to compare the debt to. A popular ratio is the debt to equity ratio. Here we take a company's debt and divide it by the company's equity. Let's say Company A has 20 million in equity. Company A has a debt to equity ratio of 0.5. 10 million in debt divided by 20 million in equity equals 0.5. Company B has 500 million in equity. Company B has a debt to equity ratio of 0.1. 50 million in debt divided by 500 million in equity equals 0.1. By comparing both companies' debt to their equity, we can easily compare the two companies. We now know Company B has less debt compared to its equity than Company A. Based on this, you might assume that Company B is less risky. This might be a dangerous assumption. While financial ratios are helpful, they shouldn't be used on their own. Financial ratios work best when they are analyzed alongside other financial ratios. We can sort financial ratios into 5 main types: profitability ratios, efficiency ratios, liquidity ratios, leverage ratios, and turnover ratios. In this video, you'll learn about profitability ratios, how to calculate them, and what they are used for so you can be a better investor and analyst. Let's get started. Profitability ratios tell us how good a company is at generating profit from its revenue. The 3 most popular profitability ratios are gross profit margin, operating profit margin, and net profit margin. To calculate all 3 of these ratios, all we need is the income statement. Our first ratio is gross profit margin. Gross profit margin tells us how much profit is left over after we subtract the cost of our goods and services. Here, I have an example income statement. To calculate gross profit margin, we divide gross profit by revenue. Our gross profit is $900 and our revenue is $1,000. 900 divided by 1,000 equals 0.9. Profit ratios are often expressed in percentages. To get that, we simply multiply by 100, or in Excel, simply press the percentage button. Our gross profit margin is 90%. A gross profit margin of 90% means for every dollar in revenue, we keep 90 cents in gross profit. Our second ratio is operating profit margin. Operating profit margin tells us how much profit is left over after we subtract the cost of our goods and services as well as our operating expenses, such as administration, research and development, and depreciation. To calculate operating profit margin, we simply divide operating profit by revenue. Our operating profit is $800 and our revenue is $1,000. 800 divided by 1,000 equals 0.8, or 80%. An operating profit margin of 80% means for every dollar in revenue, we keep 80 cents in operating profit. Our third profitability ratio is net profit margin. To calculate the net profit margin, we divide net profit by revenue. Net profit margin tells us how much profit is left over after we account for all of our expenses, including interest and taxes. Our net profit is $525 and our revenue is $1,000. 525 divided by 1,000 equals 52.5%. For every dollar in revenue, we keep 52.5 cents in net profit. For all 3 profitability ratios, the higher the better. Let's calculate the profitability ratios for Nike. Here we have the income statement for Nike for the year ended 31 May 2023. Let's calculate the gross profit margin. Gross profit margin equals gross profit divided by revenue. Remember, all these numbers are in millions. Gross profit was $22,292. Revenue was $51,217. 22,292 divided by 51,217 equals 0.44, or 44%. Now let's do operating profit margin. Operating profit margin equals operating profit divided by revenue. Nike hasn't calculated operating profit for us, but it's not hard. We just take gross profit and subtract total selling and administrative expense. Gross profit was $22,292. Total selling and admin expense was $16,377, which leaves $5,915 in operating profit. Revenue was $51,217. $5,915 divided by $51,217 equals 0.12, or 12%. Now let's do Nike's net profit margin. Net profit margin equals net profit divided by revenue. Nike's net profit, or income, was $5,070. Revenue was $51,217. $5,070 divided by $51,217 equals 0.10, or 10%. So we know Nike has a net profit margin of 10%. So what? While calculating these ratios is useful, their real value comes in comparing them. You might do this by comparing the net profit margin of Nike to the net profit margins of Puma and Adidas. If one of these companies has a higher net profit margin, it might indicate that it is a better company. Or you might calculate the operating profit margin of Nike for each year of the past 10 years to see if it is increasing or decreasing. This could help you in determining if Nike's operating profit margin is likely to increase or decrease in the future. Luckily for you, you don't have to do this all manually. You can go to a website such as koifin.com. It's free to create an account. Go to Graphs, search the company you want. I'll do Nike. Add the metric you want. I'll do gross profit margin annually. Then choose your data range. I'll choose 10 years. Here I can see the gross profit for Nike for each of the past 10 years. I can also add another company to see how they compare. Click Add Ticker. Choose your company. I'll do Adidas. Now I can compare the gross profit margin of Adidas to Nike. Sites like Koifin are excellent for quickly viewing information on companies, but if you are first learning about financial statements, I think it's valuable to calculate these ratios yourself, as they will help you understand what goes into them and how they actually work. In the coming videos, I'll be discussing more financial ratios, such as the debt-to-equity ratio, return on capital employed, and more. If you're interested in those, hit the subscribe button so you're notified when they are out. Let's summarize. To help with stock analysis, investors will calculate ratios. These ratios help to compare one company to another or a company today to its past. A ratio is when you compare one thing to another. There are 5 main types of financial ratios: profitability ratios, efficiency ratios, liquidity ratios, leverage ratios, and turnover ratios. This video, we focused on profitability ratios: gross profit margin, operating profit margin, and net profit margin. For more videos on investing, follow Value Theory or go to valueinvestoracademy.com.